This podcast is produced by Linear B Group, the leading communications, marketing and governance consultancy to the private capital industry. You're listening to Fund Shack. I'm Ross Butler, and today my guest is Raja Hadji-Touma, partner at Corsair Capital and head of European Buyouts. Raja joined Corsair in 2006 and is based in London. From 1997 to 2000, while at Corsair, he was a member of JP Morgan's Financial Institutions Group. Before that, he was responsible for establishing Babcock & Brown Global Partners. Raja,
yes,
welcome to Fund Shack.
Thank you.
Tell me a little bit about Corsair Capital. I know it's associated with JP Morgan. In fact, I worked this out all by myself because I was reading a history book and Corsair was the name of JP Morgan's yacht. And I thought, I bet Corsair Capital. Anyway, you tell me about it.
That's absolutely correct. JP Morgan had three boats, Corsair 1, 2, and 3. And when the fund was established, it was the first private equity fund effectively anchored by JP Morgan. It was part of JP Morgan. They had recruited a very established banker operating the financial services ecosystem, hired him. And, his idea was, why don't we tie the name to the Corsair history? He loved the boat. And so, yes, he called it Corsair.
And so you've been in London since...
I've been in London since 2000.
Right. And you're head of European Buyouts. What fund are you on?
We are on Fund 6. We've been basically investing since 1994. And I've helped basically establish and develop the London office since rejoining in 2005 when we started working on spinning the business out of JP Morgan.
Right. So do you invest out of one fund transatlantically?
Absolutely. One fund, transatlantic, one IC. We invest between North America, mainly the US and Europe.
What makes you different? Why do people invest in you?
I think what makes us different is that, for one, we've been operating in the financial service ecosystem for a very long time. So we have a very deep knowledge of all the different segments of financial services. We understand regulations. We understand the operational intricacies as well of operating in the financial service ecosystem. And we've been doing this in sectors like insurance and banking and wealth management, asset management, to name a few. So people have backed us because effectively we've got this deep knowledge of a sector. Obviously, over the years, we've supplemented this with a lot of other tools to create value in the portfolio companies that we invest in. But first and foremost, they see us as really have a deep understanding of the sector, and which allows us to identify trends in advance and pick the right types of businesses.
So obviously, you're a financial services sector specialist investor then, and people might think, well, you spun out of JP Morgan. That makes total sense. But a lot of private equity firms spin out of financial services in the financial services industry, and they don't necessarily specialize in finance. It's not. It doesn't. The one doesn't necessarily follow the other. So, what's interesting about financial services as a private equity investor, generally speaking? Why is it a good idea to specialize in that area?
I'll answer that. But first, I would say when we were set up within JP Morgan, the idea was it was on the back of the savings and loan crisis in the US. And the idea was to bring private equity capital to help resolve a lot of businesses, banks, insurance companies, and others that had gotten into trouble. So it's very much a strategy of focus on financial services because it was something that JP Morgan understood, and there was a very substantial opportunity to recapitalize, restructure. Why do we find it interesting today? Just to put into perspective, the strategy has materially evolved since those days. We're talking about probably 25, 30 years later. We've moved away from investing in capital-intensive businesses, in part because it's hard to create value and kind of get heavily involved operationally to drive better successes than if you invest in a capital-intensive businesses. Effectively, all you're doing is fixing a balance sheet, and then hopefully things go for the better from that point onwards. But our strategy has changed, and it's pivoted and evolved in the sense that today, we invest in asset-light services and businesses that are there supporting the overall financial services ecosystem. In truth, they're not all financial services, traditionally financial services business. We're talking about business services, which cater to the financial service ecosystem. For instance, trust and corporate services, fund administration, insurance distribution, brokerage, MGAs, and other such like professional services assets. And now we invest in technology, mainly software, enabling, digitizing the financial services ecosystem, as well as B2B payments, integrated payments, and a number of other vectors that fall under financial services. So it's a very broad market. There's a lot of change in those markets, partly driven by adoption of technology, partly driven by the need for a lot of incumbents to become more efficient, to digitize, and a lot of outsourcing trends using kind of specialist providers to effectively replace some of the activities that are done by incumbents in the past.
Right. So the thing with this, of course, is that software is eating the world, and it's particularly eating, I'd say, the financial services industry. And so by moving away from balance sheet risk, you really do become more on the digital and tech side. How have you built those skills?
Absolutely. Yeah. That's all we do. Business services, technology, and as I said, some payments. How did we build those? Well, first of all, we built them over 25 transactions. So it's a skill that we've honed over time. We came at it with the knowledge of the industry. We came at it with a very strong set of networks in the ecosystem. And what we had to develop over time was effectively the understanding of the more intricate understanding of the technology sector as one of the verticals we invest in.
Everyone needs to digitize, let's say, and there are plenty of consultancies out there telling you you've got to digitize. Well, you invest across the financial services industry, which is very kind of, it's very diverse. Right?
Yes.
So to what extent do you draw lessons from one investment to another? Or is it just like, well, digitizing insurance business is very different to digitizing some other business services?
No, I think it's a good question, but I think ultimately digitizing a process is going to be consistent across the board. What makes us a difference is our understanding of the end market that is being kind of tackled.
Yeah.
So I'll give you an example. We invested in businesses that are upgrading, digitalizing the insurance value chain in terms of policy administration software, the market management software. There, obviously, we're investing in businesses that have those capabilities, but our understanding, it really comes at it from the lens of, the insurance market and the legacy issues that they have, the pressure on their business from a margin perspective, and what they have to do to keep up with the times and the demands of new customers that are looking for more effective communication channels, better quality data, faster engagement, faster pricing, to name a few examples. And so there, we're picking a market that we think is ripe for digitalization.
Yeah.
And it comes with two lenses. One is the financial services one, and the other one is obviously through our network and through our operating partners, supporting the business and continuing to invest in the products that are going to help digitalize these segments.
So you can invest both in the company that needs the help, but you can also be investing in the business service that solves the problem that helps that type of company.
Correct. So we invest across, as I said, we invest in insurance distribution businesses today, so brokers, MGAs, and we've invested in insurance software businesses. One is obviously the one providing the service, distribution, whether it's in P&C or other segments. The other one is really just the plumbing and the technology that's supporting the large carriers in the industry in ways that will help them become more tech-enabled.
How hands-on do you have to be in terms of portfolio value creation for these types of businesses?
I think the answer is we want to be very involved. I think one of the things that I'm very proud of when we talk about the way we run our business is that we come at it with a very strong lens around, and when we're engaging with management teams, we understand their end market, we understand their product, we understand the complexities that they're dealing with. But we're very proud to be very hands-on when it comes to providing a value creation plan. And for that, it starts really even the moment where we start to underwrite a transaction. It is where, as we align with the management team, what are their challenges? What are they trying to rectify? What are they trying to build to in the future? We set up a very clear 100-day plan, a longer-term plan, And we also in all cases, basically design what the company needs to look like in 4 to 5 years' time to meet our strategic objectives, which is typically to build a category leader. And from that point onwards, we bring in at our scale, which we haven't talked about this, we invest at businesses of, let's say, 5 to 20 million of EBITDA. We bring in very significant resources to help smaller businesses institutionalize. And those resources, take the form of operating partners that are focused on talent, i.e., how's the organization set up for scaling? Does it have the right people in the right roles? We do all sorts of assessments on the management team and plan ahead around how the team needs to look like and develop over time to be able to meet those objectives, particularly in people businesses, which some of the business services activities that I mentioned earlier are. We bring people that understand go-to-market and how to drive better performance around your go-to-market activity, whether it's in sales or marketing, whatever it may be. We have technology people and we have M&A people to help companies at that scale that require support in mapping the market for potential bolt-ons. We do a lot of buy and build, so bolt-ons, and help them execute so they can also keep their eyes on running the day-to-day business. These are just a few examples of what we do, but we are extremely involved. We're not backseat drivers, just to be clear, but we're very much there in terms of aligning early on with our management teams of the journey that we're about to embark on.
So you've given me some examples of value creation. Given the difficult trading environment, like global macro environment at the moment, would you change the emphasis on any of those, or any particularly important, or any rising up the agenda in terms of, we're consistently seeing that we need to fix this in terms of value creation?
I think value creation is more important than ever. I think when I think about the market that we're in, and particularly the segment of the market that we operate in, the way you generate real alpha is by buying businesses and putting them in a shape and condition to become valuable assets to potentially strategics. So taking businesses from 5 or 10 or 15 million of EBITDA to bring them to 15, 50 is a journey that requires a lot of hand-holding, a lot of kind of getting involved in driving the value creation agenda. And I think that is a must in this market, particularly with growth rates which are a little bit suppressed, with the cost of debt that is higher. I think there is no doubt in our minds that is the way to generate alpha. It's also, for us, is now in our DNA, that's how we're going to convince management teams that we're the right partners for them. I.e., we understand your sector, but also we will bring a set of resources you wouldn't otherwise get in a firm investing in a business of your size.
Yeah, I've got to admit, I thought you'd be investing in slightly larger businesses just because of the JP Morgan name and financial services, but these are actually relatively small businesses, 5 to 20.
Absolutely.
EBITDA. Yeah.
We used to invest in multi-billion-dollar banks.
So you've really changed strategy.
But this was probably 35 years ago.
Yeah.
As I said, in the last 20, 25 deals have been in the range of 5 to 20, 25, depending, potentially a little bit higher in the US than in this market, where I feel that is a really nice sweet spot for us. There is a lot of value to be generated building up businesses from that scale to what I said earlier, 50, 60, 70 million of EBITDA. You then open yourself to a much larger group of potential acquirers and probably capture kind of a valuation uplift in the process.
And what kind of management teams are coming to you at that level? They're going to be entrepreneurial, small? Are they spinning out of financial institutions, or?
They are a lot of the management teams we back are businesses that have several of them are founders that have done it before, that are doing it again.
Nice.
So we invested in trust and corporate service and fund admin. Stellar entrepreneur has done it, one in an institutional environment, one as a founder, and this is his third time going. We invested in insurance distribution, same story, second time founder. Oftentimes they are founder-owned, or they have some instances they've been kind of institutionalized, so the founders are no longer in the business. But it's really that kind of a profile of company where we have to be quite engaged
Yeah. What's deal flow like at the moment in late 2024?
I think the deal flow is good. It's not as good as we would like. I think there is clearly a market that is barbelled in the sense that good assets are getting bid up and still preempted at pretty attractive valuations. And a lot of the market has been discarded or has been less, has received less interest. So you've got a market that's a bit barbelled. Private equity needs to sell assets. I expect that things will get a bit better. I said that probably 6 to 9 months ago, thinking the rate cycle was going to change. It hasn't. I think that I expect that hopefully I'll get it right this time around. In the next 6 to 9 months, things will get a little bit better. We're seeing a small uptick in transaction volumes. We're seeing more opportunities, more higher quality opportunities, I shall say, because there's a lot of businesses that want to sell, but maybe are not, meeting our requirements.
What's looking attractive to you at the moment in terms of subsectors and strategies?
We still like a lot insurance distribution.
Why is that interesting?
It's interesting because, first of all, it's a market that is still ongoing a pretty significant amount of consolidation. You've probably seen there's a large number of players have been created over the last 10 years, both in the UK and in other markets like Germany. But there's still quite a room to grow across continental Europe to continue to roll up these businesses. We have a very strong focus on businesses that have real sustainable revenue profiles, recurring or reoccurring revenue profiles, and attractive cash flow conversion. Obviously, insurance distribution fits that model. We also like fragmented markets where we can deploy our M&A capabilities to help on the buy and build side. Again, the market remains quite fragmented. And I like it because I think that if you can, again, buy businesses in the scale that I've talked about and bring them to 25, 30, 40 million of EBITDA, there are a lot of strategic options when you come to exit them because the market, there's a lot of very large private equity-backed businesses that have been created, as well as a large number of strategics, both in North America and in Europe, that are making some the M&A a high priority.
Yeah, but the strategics aren't going down to your level of investment. What about other private equity type investors? You're above the venture and growth guys, but it's actually quite small buyout. How much competition do you face for these types of assets?
You still face competition. I mean, you'd be surprised. In insurance distribution, we've seen businesses that we want to look at that are in the 10 million EBITDA, and you have strategics looking at them.
Oh, you do?
Depends on the quality of the yes, absolutely, because ultimately. They want to get, let's say a strategic wants to get a foothold into a market, they're going to look for a platform, as do we.
So the financial services is obviously a highly regulated industry. To what degree do you look at regulatory risk when you're going, investing in companies for 4 or 5 years, presumably? So that's presumably always something on your mind.
Absolutely. Every business that we invest in, we're always, given our DNA, we're very focused on regulatory. The potential changes in regulations, how it may impact the business. That's part of what we do. I'd say that given we're investing a lot more in asset-light services, we're investing, solely in asset-light services, the regulatory framework is not as demanding as you'd have in kind of, banks, insurance companies, and the like. So it's still something that's very important, and we need to understand it. And the management team wants partners that understand that. But I think it has maybe a diminished impact going forward around the value creation plan.
Well, I said regulatory risk. There's probably regulatory opportunity as well in your market.
Absolutely. That's probably more of a driver of opportunity. You've hit the nail on the head there. There's a lot of business opportunities whereby regulations come in. I mentioned trust and corporate services, more regulations, more demand for KYC, AML, regulatory reporting, whatever it may be. And these drive increased demand. And therefore, it helps our portfolio companies that are operating in certain sectors. It also provides us with new kind of lens on potential new opportunities of investing in businesses that are catering to those regulatory requirements.
So you're head of European buyouts. You're sitting in London, but you're covering the whole of Europe. You've mentioned Germany already, but what's the geographic aspect of your job, and how does the single market affect it? Do you see different countries looking more or less attractive?
The benefit of, well, I'm based in London. Obviously, I have a team based here with a number of also operating partners that are on the ground in the local markets. So we like to centralize the investment decisioning in the UK, but have boots on the ground in continental Europe. And in terms of markets, yes, obviously, depending on the trajectory of different macro economies, we'll probably consider whether we're more inclined to invest or less inclined. We can't be that picky though, because ultimately we invest in a certain sector. We're thematic. We pick themes that we think are interested, and then we have to basically go and find the businesses that we find are better suited for the journey that we want to take them on, that have the right profile, both people and kind of financials. And so, while I could say I only want to invest in X geography versus this one, it really also, you have to evaluate it based on those kind of deals that you can unearth through, as I said, through what is a very proactive, outgoing kind of effort to identify and source deals.
Yes, you have a very thematic top-down approach. You know what you want to invest in, and then you go and find that type of business.
Absolutely. We spent our time saying, what are the drivers of different sectors?
Yeah.
We spent time market mapping those sectors and then approaching these companies. And so I may have the same strategy across continental Europe and find the right asset in, let's say, Germany, and not find it in another market. Therefore, I will invest in Germany.
There's a lot of legwork involved in that, presumably. Either.
Absolutely. But look, ultimately, given our specialization, there's always a lot of work to originate deals. We've originated 7 of our last 9, I think, in a bilateral situation. So we do a good job of it. But ultimately, you need to be very persistent, and you need to be able to also be very clear with the market as to what you're looking for. What are the characteristics that are attractive to you? And if you do a good job in that communication effort, typically you'll see some interesting opportunities come through.
Obviously, the fintech market, there's a lot of hype around that. I assume you don't get involved in B2C fintech, and how does that impact what you do?
I'm not a huge fan of the B2C market. We typically invest more in B2B businesses or businesses that have very similar kind of financial characteristics. Back to the reoccurring nature. The market's been impacted in B2C. There's no two ways about it. There's some large players that are also becoming dominant, but a lot of kind of smaller players that were more VC funded invested quite significantly to try and gain market share, and that process has reversed itself a little bit. And so you're seeing a market that is a bit in flux, I would say, in terms of kind of B2C opportunities in fintech.
Are there any mega trends that, without giving away any trade secrets or anything, but are there any mega trends that you're following that could throw up investment opportunities? So I'm thinking, we're not that far out of the global financial crisis, which had a whole raft of regulation, and then there's open banking, which presumably that was some kind of opportunity. Is there anything happening at the moment, any general industry trend, whether in a subsector or generally in financial services, that you think could throw up opportunity?
Absolutely. I think one of the opportunities that is there and emerging, there's, I guess, a couple I can refer to. One everyone talks about is AI and how it's going to impact impact kind of the ability of businesses to operate with more velocity. People also talk about disintermediation or the impact it could have on businesses. I see that as an opportunity. So we're looking for businesses that can use the tools in place at the moment to be able to drive better performance, better efficiency in more traditional professional services segments. So that are helping basically leverage those competencies, which are going to become more and more developed, I think, over the next several years, to be able to provide solutions that are going to effectively replace more manual processes and do it more efficiently. And you see that across professional services.
So difficult question, but on average, what proportion of their R&D budget are your companies spending on that opportunity, on AI?
As of now, they're not spending a
Right.
huge amount. If you're talking about our software businesses, they are spending on AI. They're also spending. You don't want to be reinventing the models or that are being created by large kind of the hyperscalers. You want to figure out how to embed that in your processes to be able to use them, apply them to very specific use cases so you can get the value out of the tools that are out there. So we have businesses that are in data automation. We have businesses that operate in identity and fraud prevention. They're all looking and developing partnerships with the hyperscalers or others to basically use AI to help innovation and to accelerate kind of to become more productive.
So you said AI, and it seemed like you were going to say a second mega trend. But
second one is a pretty large trend. It's probably it's a trend around B2B payments, accounts payable automation, accounts receivable automation. It's you've had over 10, 15 years a huge focus on B2C payments and on PSPs and otherwise. That has created some very large players in the market. I think there's less it's less of an exciting journey from this point onwards, whereas B2B is more underpenetrated segment of the market. There is significant requirements for companies in terms of automating, improving their working capital management, the accounts payable automation side of it. And so that's an area that we find very interesting, and we think it has long-term secular tailwinds, whereby if you back the right businesses, you could justify pretty attractive returns in the future.
If you were to stand back a long way from financial services as an investment sector, would you say the next 5 or 10 years, is it going to be bigger than it has been or smaller? Because you can, in some senses, when tech hits a sector and makes it radically more efficient, presumably there is a point at which that growth plateaus. So what's your general view on financial services as an investment sector?
I think it's going to stay there and it's going to continue. I mean, people forget financial services, and obviously that includes banks and otherwise, but it's probably 25, 30% of global GDP. It's a massive sector. And as I said, under the umbrella of financial services, you've got a proliferation of different businesses that cater and provide infrastructure or enablement to the ecosystem. So I think with GDP growth, with new technologies, with kind of more outsourcing, which is going on by large financial institutions more and more, that's a big trend of using third-party providers. I see kind of the financial service ecosystem growing from this point. So I'm not worried about the size of the market, put it this way.
It sounds like an exciting area to be in. Good luck with with the next part of the cycle.
Thank you very much.
You've been listening to the Fund Shack podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.